Welcome to the Deep Dive. Today we're tackling Sterling infrastructure, ticker STRL.
That's right.
You sent over a really comprehensive research analysis. It looks like it's dated April 10th, 2025, and even an ad. So quite a bit to work with here.
Exactly. And our goal today really is to kind of get under the skin of Sterling. We want to understand, how they make their money, who's actually calling the shots over there, how strong their financials look,
Right.
what the market sentiment is, who owns the company, and importantly, what are the potential bumps in the road, the risks.
Okay.
Ultimately, the idea is to give everyone listening a clearer picture of, their long-term investment potential based on the info you shared.
Okay, sounds like a solid plan. So let's unpack this. First half, we'll dig into the business itself, then maybe size up the management team.
Yep.
And finish that half looking at financial health. After a quick break, we'll hit market sentiment, the ownership structure, and those risks. Yeah, sound good?
Sounds great. Yeah, let's dive in. Starting with the business itself seems like the right place.
All right, Chapter 1, Business Understanding. So, in a nutshell, what does Sterling Infrastructure do? They seem to have their fingers in a few pies.
They do. They're basically a diversified infrastructure services provider operating primarily within the U.S.
Okay.
They've got like three main engines: infrastructure solutions, transportation solutions, and building solutions.
Right.
And how they make money. It's all project-based contracts, really, securing the work, delivering the project.
Okay, let's break those down. Infrastructure solutions. It sounds, I don't know, plugged into some pretty big trends right now.
It really is. This is actually their fastest growing segment. And importantly, it also carries their highest profit margins.
Okay.
They're focused on these big, large-scale site development projects. Think data centers, those huge auto-commerce warehouses you see everywhere, advanced manufacturing facilities like for EVs, batteries, solar panels, semiconductors.
Yeah.
The really cutting-edge stuff.
Yeah.
They also do warehousing, energy projects. And they work with some really big names, blue chip clients in this space. It's become a real powerhouse for them.
Right. And these aren't just like generic warehouses, are they? These are complex builds.
Exactly. Often mission critical for the digital economy, which, gives Sterling a bit more pricing power and helps build those long-term relationships.
That makes a lot of sense. They're building the foundations for, well, a lot of the future growth we keep hearing about.
Precisely.
Okay, now transportation solutions, that sounds maybe more like traditional infrastructure work.
Exactly right. Transportation is, building and fixing up vital public stuff. Highways, roads, bridges, airports, ports, rail networks, even the essential water and storm drainage systems. Now, this was historically their core business.
Right.
But they've made a strategic shift here. They're focusing more on higher margin opportunities within this segment.
Oh, so?
Well, things like using alternative project delivery methods. Design build, CMGC approaches.
Okay, yeah, more collaborative.
Right. More value capture for their expertise. And they're also focusing more on specific areas like aviation and rail projects and kind of selectively moving away from some of that lower margin, traditional, heavy highway stuff.
So a deliberate move towards more profitable niches there. Makes sense. And the last piece is building solutions. What's the focus there?
Building solutions is primarily about concrete foundations for residential construction.
Oh, okay. Homes?
Yeah, both single-family homes and multifamily units. They mostly partner with the big national home builders, particularly in those high-growth markets like Texas and Arizona. They do some commercial concrete work too, like parking garages. But an interesting recent move was acquiring Professional Plumbers Group, PPG, back in 2023.
Oh, plumbing.
Yeah, it adds plumbing solutions to their offering for those same home builders, so they can provide a kind of more bundled service now.
Okay, so they're covering a surprisingly wide range. The report mentions several specialized subsidiaries. What's the thinking there? Seems like a lot of names.
Yeah, it might seem like a lot, but those subsidiaries are actually a key part of their strategy. It lets them offer comprehensive services across the whole project lifecycle.
How so?
Well, each one brings specific expertise or maybe a geographic focus, like Plateau Excavation and Patio. They're the go-to guys for that huge infrastructure site development work.
Right.
RLW specializes in accelerated bridge construction, faster completion, less disruption. TSC is focused on heavy civil in Texas. Tealstone does foundations. Benicki in the Southwest. RHB handles heavy highway and airports. And PPG, as we said, brings the plumbing.
So it's like having specialized teams under one big umbrella.
Exactly. Deep expertise in different niches.
Got it. What about their overall market position then? Scale. Are they a major player?
They're definitely establishing themselves as a leader in the segments and areas they choose to operate in.
Which areas are those mainly?
Primarily the southern and southwestern U.S., the Rocky Mountain states, the Northeast and Mid-Atlantic, thanks to that PTO deal,
Really?
plus Nevada, California, and Hawaii. It's a pretty significant footprint, hitting a lot of the fast-growing parts of the country.
And the growth numbers reflect that.
Oh, yeah. Their revenue growth has been, frankly, quite impressive. Went from about $534 million in 2016 to over $2.1 billion in 2024. That's substantial scaling.
Wow, okay. So if I'm a potential client, why choose Sterling? What's their main pitch, their advantage?
For clients, it really boils down to their proven ability to handle these big, complex projects reliably, especially in that hot e-infrastructure space.
Execution is key.
Absolutely. They emphasize a customer-centric approach using all that specialized knowledge from their subsidiaries. Basically, they're saying, got a massive, complex job with tough deadlines. We've got the teams and the track record to nail it.
And flipping that, what about for investors? Why would someone look at Sterling?
For investors, the story is that consistent track record of profitable growth, plus those expanding profit margins shows efficiency, maybe pricing power, their strong cash flow generation, and a really solid balance sheet, which gives them flexibility. A lot of this comes back to that strategic transformation we talked about.
The pivot away from low-margin highway work.
Exactly. Shifting to be more diversified, focusing heavily on e-infrastructure. That move, driven by the current management since 2017, plus those smart acquisitions, that's really been the engine for creating value.
And you mentioned ROIC earlier, return on invested capital.
Yeah, we'll get into the specifics later, but their ROIC numbers are strong. It signals that the money they're putting back into the business isn't just growing it, it's generating really good returns above what that capital cost them. That's key for long-term value.
Okay, that gives us a really solid grasp of the business itself. Let's move on then. Chapter 2, Management Evaluation. First up, leadership assessment. Who's running the show and what's their track record like?
Right. The CEO is Joseph A. Coutillo. He took over in February 2017.
Okay, so right when that big strategic shift started happening.
Precisely. His tenure lines up perfectly with this transformation. And under his leadership, well, Sterling hit record revenues, profits, margins, and cash flows for 5 straight years through 2024.
It's quite a run.
It is. Plus, they did those key acquisitions we mentioned, margins went up, debt came way down, and the share price saw significant appreciation during that time. The average tenure for the management team overall is about 4.3 years, so, reasonable stability there.
Now, there was a mention of a recent change at CFO. How does that factor in?
Yeah, that's right. Sharon Villaverdi stepped down recently. Ronald Balschmeid is the interim CFO now.
Is he new to the company?
Actually, no. And that's the key thing here. Balschmeid has a long history with Sterling. He was their CFO and chief accounting officer before for a good stretch.
Ah, so provides some continuity.
Exactly. It helps mitigate potential disruption during the transition while they search for a permanent replacement. Having that experience step back in is definitely a plus.
How has the team handled challenges in the past, like crises?
Well, the analysis doesn't list every single past issue, but it does mention navigating the COVID-19 pandemic.
Right.
Which, kind of ironically, exposed supply chain issues that actually fueled some of the onshoring trends that now benefit their e-infrastructure side.
Interesting.
Yeah. So they adapted their strategy then. The more current challenge is definitely the stock price volatility we saw in Q1 of 2025. That's something they're managing now from an investor relations standpoint.
And how transparent are they? Communication with investors, the market.
They seem pretty transparent, actually. Regular quarterly earnings calls with analyst Q&A.
Standard stuff.
Yeah. But they also hit investor conferences, share detailed presentations. They put out comprehensive annual reports and increasingly detailed sustainability reports, too. Their IR website is pretty good, easy access to financials, filings, presentations.
And they explain their strategy clearly.
Yeah, they articulate the company strategy well and break out results by those 3 segments, which gives you good visibility into what's driving performance.
What about ethics? Any red flags or positive mentions there?
The research highlights their commitment through something called the Sterling Way.
Oh, wait.
They have a formal code of business conduct, an ethics and compliance program overseen by the board's audit committee, a chief compliance officer. They do regular ethics training. Importantly, the research didn't mention any major ethical scandals or controversies.
Good. They also seem to hold suppliers to standards.
Yes, there's a separate code of conduct mentioned for suppliers, too.
So overall assessment of leadership seems pretty positive then.
Based on this info, yeah. Management, especially CEO Cotillo, seems capable and pretty shareholder-oriented. You look at the turnaround, the financial results, the transparency, the ethical commitment.
Hmm.
It paints a good picture.
And the CEO bought stock recently.
Yes, that's another point. He made a pretty substantial open market purchase in February 2025. That's usually seen as a strong vote of confidence from the top.
All right, let's shift within Chapter 2 to capital allocation. How are they putting their money to work? Is it effective?
Their approach seems pretty well defined. Focus on three main things: reinvesting strategically in the core business, smart M&A, and returning capital via share buybacks.
Okay, so reinvestment, mostly in that e-infrastructure segment.
Exactly. They've clearly prioritized that, given the growth potential. But they also seem disciplined about capital expenditures overall, looking for investments that offer good risk-adjusted returns.
And M&A has obviously been a big part of the story. What's the strategy behind the deals they've done?
It seems very targeted, mostly aimed at expanding geographically or adding complementary services in their key growth market.
Like the Patillo deal.
Right. Patillo in 2021 got them into the Northeast Mid-Atlantic for e-infrastructure. Plateau Excavation earlier boosted e-infrastructure in the Southeast.
And the building solutions ones.
Yeah, Tealstone and CCS in 2022 strengthened their presence in Texas and Arizona. And then PPG in 2023 added that plumbing capability. All seem to fit that strategic goal of shifting towards higher growth, higher margin areas, and expanding their footprint.
And they look for cultural fit, too.
Management has mentioned that, yeah. Good cultural fit and deals that are expected to be accretive to earnings.
They've also been buying back shares, right? What's the deal, though?
Yes, they have a history of that. Had a program from 2018-2020. Then, more recently, December 2023, the board authorized a new $200 million program over 2 years.
Have they used much of that?
They bought back $20 million in Q3 24 and another $20 million in Q4 24. So $40 million pretty quickly under that new plan. Management calls the buybacks opportunistic, depends on market conditions, cash flow, other opportunities.
Okay. What about dividends? Are they paying anything out to shareholders?
No, currently no dividends on the common stock. Their priorities right now are reinvesting organically and through M&A and those share buybacks. Pretty typical for a company focused on growth.
Let's talk ROIC again, return on invested capital. The research mentioned impressive figures. What does that really tell us?
ROIC is super important. It shows how well they're using the capital they have, both debt and equity, to generate profits.
And Sterling's numbers are good.
Yeah, the research cites figures from Morningstar, Simply Walsing, Chartmill, Fintel, and the consensus is their ROIC is strong and getting better. Simply Walsing had their ROCE, return on capital employed, similar measure at a very healthy 22%.
And that's better than peers.
Significantly better than the industry average, according to the data. Chartmill also noted they outperform a big chunk of their peers. And what's interesting is management themselves set a 22% ROIC target in their updated framework.
So the strong ROIC suggests their strategy is working.
Absolutely. Consistently high ROIC, well above their estimated cost of capital, strongly suggests that focusing on higher return businesses and being disciplined with investments and acquisitions is effectively creating shareholder value. The capital they deploy is generating real returns.
Okay, that's a thorough look at management and capital use. Let's move to Chapter 3, financial health, starting with the key metrics.
Sounds good. So as of April 10th, 2025, market cap was around $4.12 billion. Share price closed at $134.53.
And the PE ratio, how's the valuation looking?
Well, the trailing 12-month PE has generally been in the, say, 14x to 22x range recently. Based on their FY24 EPS, it works out to about 16.3x.
I'm looking forward.
The forward PE estimate for FY25 is pretty similar, maybe 16.0x to 17.0x, so generally in line with, or maybe even a bit below, broader market multiples.
What about revenue growth, top line performance?
Trailing 12 months, end of Distributed 24, revenue was $2.12 billion. That was up a solid 7.3% year over year.
But Q4 was slower.
Yeah, Q4 2024 year-over-year growth was a bit lower, 2.6%. And looking ahead to FY25, guidance suggests a reported decline in revenue.
Oh.
But that's because of an accounting change with their RHB subsidiary we touched on. On a pro forma basis, adjusting for that, they're actually guiding for growth up to 10%. So underlying growth still looks strong. Long-term revenue CAGR has been impressive.
And margins, are they making good money on that revenue?
Margins look quite healthy, yeah. TTM gross margin around 20.1%, operating margin about 12.5%, net margin near 12.2%.
And those are improving.
Yes, that's the key point. Significant expansion from historical levels, especially that gross margin. It suggests better profitability, maybe more pricing power.
Let's talk debt. How much leverage are they using?
Very little, actually. Debt-to-equity ratio is quite low, somewhere in the 0.36x to 0.38x range. Very conservative.
And that's improved.
Significantly, much better than levels back in 2021. Really shows a strengthening balance sheet, less financial risk.
Free cash flow, always a favorite metric. How are they doing there?
Generating strong free cash flow. For FY 2024, it was about $416 million. That works out to roughly $13.39 per share.
So healthy cash generation relative to the price.
Exactly. Leads to an attractive price-to-free cash flow ratio. Shows they're throwing off a good amount of cash compared to their market value.
And price to book value. Any insights there?
That ratio was noted in the range of about 4.3x to 6.4x.
Okay, so summing up the key metrics. Paints a pretty positive financial picture, doesn't it?
It really does. Highly profitable, strong balance sheet, actually in a net cash position now, and healthy liquidity ratios. Current and quick ratios are both around 1.3x to 1.4x. Looks solid.
Okay, let's dig a bit deeper into financial stability now, still in Chapter 3. How consistent have earnings been? That's often a concern in this industry.
Yeah, cyclicality can be an issue, but following that strategic turnaround, their earnings have shown impressive consistency and strong growth.
Those 5 record years.
Exactly, 5 consecutive years of record top and bottom line results through FY24. Adjusted EPS growth has been substantial, too.
Is that expected to continue at the same pace?
Well, the forecast for FY25 suggests growth might moderate a bit compared to those really high rates, but it's still expected to be positive. It's a huge improvement in consistency compared to before 2017 when things were more volatile.
Okay, and dividends, we know they don't pay one. So focusing on debt management again, but specifically for stability.
Right, and their debt management is a major strength here. We mentioned the low debt to equity. But even more, they hit a net cash position of $348 million end of Q4 24.
Meaning cash exceeds total debt.
Precisely. Their operating cash flow easily covers debt obligations. Interest coverage is exceptionally strong. They're actually earning more interest income than they pay in interest expense right now.
Wow.
Yeah. And management has a comfortable forward debt-to-EBITDA target, though they're way below it currently. Very prudent debt management supports long-term stability.
And how efficient are they with working capital? Managing those day-to-day operational finances.
Seems pretty reasonable. Current and quick ratios around 1.3 by 1.4x suggest adequate liquidity. Their DSO days, sales outstanding, how quickly they get paid is around 51 days.
Is that good?
It's reasonable for the industry. And their DPO days, payable outstanding, how long they take to pay suppliers is around 32 days. Suggests fairly efficient management of receivables and payables, which helps that strong operating cash flow.
So overall assessment on financial stability is also quite positive.
Absolutely. Consistent recent earnings growth, that excellent debt management leading to a net cash position, and reasonable working capital efficiency. It all points to robust and improving financial stability.
Perfect timing. Before we jump into the second half, market sentiment, ownership, and risks, let's take that quick break for our sponsor.
That's good.
Do you ever wish you had, I don't know, a dedicated AI-powered research assistant just for stocks? Imagine being able to instantly generate comprehensive reports, insightful podcasts like this one, or even detailed video scripts on any public company.
Yeah.
All tailored to exactly the level of financial knowledge you have and the depth you need for each specific area.
That would be incredibly powerful. A huge time saver for any investor.
Well, at stockanalytics.ai, we're not just imagining, we're actually building it, and it gets better. We're also developing this interactive interface. You can ask plain English questions about any stock and get instant smart answers. Picture maybe a voice-controlled stock screener that gets what you're asking for, or a portfolio analyzer that helps you de-risk and stress test your holdings super easily.
Wow, that's a really comprehensive set of tools, really designed to empower investors, it sounds like.
Definitely. Visit stockanalytics.ai today. You can see the future of financial intelligence firsthand. Check out our demo, see it in action. We've also just opened our waiting list for beta users,
Oh, okay.
offering exclusive 50% discounts for early access and even some exciting opportunities to invest in the future of stockanalytics.ai itself.
That's definitely an opportunity worth checking out for anyone serious about investing.
Don't miss out. Sign up for the beta waiting list now at stockanalytics.ai. That's stockanalytics.ai.
Yeah, be sure to take advantage of that early access.
And welcome back to the second half of our deep dive on Sterling infrastructure. We're jumping into Chapter 4, Market Sentiment. So what's the vibe? What's the overall feeling about Sterling in the market right now?
Well, as of, that April 10th date, the market sentiment seems, well, a bit mixed, actually, and maybe surprisingly disconnected from those strong fundamentals we just went through.
How so?
Well, there was that significant stock price drop in the first quarter of 2025. This happened despite the company reporting record results for FY24 and giving positive guidance for FY25.
Huh. Didn't it hit a high just before that?
Exactly. The stock hit an all-time high in January 25 and then pulled back pretty sharply. Several reasons have been floated for this. Concerns about a data center slowdown, maybe?
Even though management commentary doesn't support that.
Right. Also, a slight revenue miss in Q4, that CFO departure we discussed, which can create uncertainty, and potentially some confusion around their backlog figures. We can talk more about that.
Okay, so the market seems a bit spooked despite the good underlying news.
Seems that way. But it's important to add, some analysts see this pullback as just a healthy correction after a huge multi-year run. Some even see it as a buying opportunity.
Right. Any examples?
Yeah, Zacks currently has a #1 strong buy rating on it. Blogger sentiment has generally been positive, though some crowd wisdom indicators turned negative recently, so a bit of a split opinion out there.
What about the professional analysts? Their price targets.
Analyst sentiment, judging by price targets, is actually overwhelmingly bullish.
Really?
Yeah, the average one-year targets are clustering somewhere in the $185 to $202 range, which, implies significant potential upside from the current price, maybe 40% to 75% in some cases.
Wow. And new coverage, too.
Yeah, recent upgrades or initiations from firms like D.A. Davidson, William Blair. The consensus recommendation is definitely weighted towards buy or strong buy.
How has recent news specifically impacted things? Sounds like a mix of good and maybe less good news.
It's definitely been a blend. On the plus side, record FY24 earnings, positive FY25 guidance, big project award announcements, ongoing positive comments about e-infrastructure strength, the share buybacks, those positive analyst ratings, even releasing a sustainability report.
Okay, lots of positives.
Right. But then the negative or uncertain column has that Q1 stock decline, the slight Q4 revenue miss, the CFO leaving, those concerns and reports about declining backlog figures, and a relatively small insider sale by the general counsel. So yeah, the market's sorting through mixed signals.
Let's touch on short interest and options. What do they tell us?
Short interest seems moderate, around 5.7% to 5.9% of the float. The days to cover ratio is pretty low. Meaning it wouldn't take too long for shorts to buy back shares if they had to. So while some are betting against it, it's not an overwhelming bearish position.
And options.
Options activity. The put-call ratio is below 1.0. That suggests slightly more bullish call buying than bearish put buying, but implied volatility is elevated.
Suggesting traders expect bigger price swings.
Exactly. And trading volume has been higher than average recently too, which usually happens during these volatile periods.
So the key takeaway on market sentiment is this kind of weird divergence. Strong operations and financials, but recent stock weakness.
Exactly. It really highlights the potential for maybe market overreaction to headlines. Or maybe misinterpreting data, like those backlog figures.
Let's clarify that backlog confusion. You mentioned an accounting change.
Yes. With their road and highway builders, RHB, subsidiary, the accounting change will make the reported consolidated backlog look smaller. But, and this is crucial, it does not change Sterling's actual economic interest. They still get 50% of RHB's operating income.
So investors just seeing the lower backlog number might get the wrong idea.
Precisely. If you don't understand that accounting nuance, you might think business is slowing down when it's not, really. And this kind of disconnect, strong fundamentals, negative price action, that's sometimes where potential opportunities lie for investors who dig deeper.
That's a really important clarification. Okay, let's move to Chapter 5, ownership structure. Who actually owns Sterling? Who are the major shareholders?
Well, institutional ownership is remarkably high, usually reported somewhere between 87% and 90%, maybe even more.
Wow, a lot of institutions involved.
A significant number, yeah. And recent filings show quite a bit of turnover institutions, increasing positions, others decreasing. High institutional interest helps liquidity, but it can also amplify volatility if big players change their minds.
Can you name some of the top institutional holders?
Sure. The big names are usually there. BlackRock, Vanguard Group, FMR LLC, that's Fidelity. They typically hold large stakes. Fuller and Thaler Asset Management, Renaissance Technologies also show up frequently near the top.
Any interesting recent moves among them?
Yeah, looking at late 24, early 25 filings, you see some contrast, like Vanguard significantly increased its stake, but Fidelity reduced its position.
Huh. So even the big guys have different views.
Exactly. Underscores that different sophisticated investors can look at the same company and reach different conclusions.
What about insider ownership? Is management heavily invested alongside shareholders?
Overall, insider ownership is relatively low, around 3.18%. However, the CEO, Joseph Coutinho, holds a meaningful stake himself, about 1.43%. That's a significant personal investment.
And recent insider transactions, buying or selling.
Recent data shows net buying over the last 3 to 12 months. Insiders bought more on the open market than they sold. And specifically, as we mentioned, CEO Coutinho made that big $1 million open market purchase in February 25.
Which is generally seen as positive.
Very positive signal, yeah. Shows confidence. There was a smaller sale by the general counsel around then, but most other recent transactions look like they're related to equity compensation vesting and such.
Is ownership very concentrated? Like, do a few holders control the company?
While overall institutional ownership is high, the concentration among the very top holders is, I'd say, moderate. BlackRock has the biggest single stake, over 10%, but the top 5 combined are, well, maybe around 30%.
So that overly dominated by just one or two players.
Right, which maybe reduces the risk of one big holder suddenly shifting things dramatically.
Okay. And finally for this chapter, corporate governance. What does the research say about their practices? Are they shareholder friendly?
Sterling seems to have several good governance practices in place. Majority independent board of directors.
Standard best practice.
Yep. Fully independent board committees for audit, compensation, nominations, governance. They also have separate chairman and CEO roles, which can help with oversight.
Anything else?
The board does annual self-evaluations. They have stock ownership guidelines for executives and directors, aligning their interests with shareholders. And they recently added a new board member with relevant experience.
So overall, governance seems designed to promote accountability.
Yeah, these kinds of structures and practices are generally aimed at accountability, ethical conduct, and making sure the company's strategy aligns with shareholder interests.
Okay, great. Let's move to our final main chapter, Chapter 6, Risk Assessment. Time for the SWOT analysis, strengths, weaknesses, opportunities, threats.
Right. SWOT gives us that structured overview. Internal factors first, then external.
Let's start with strengths. What are Sterling's key advantages?
Okay, key strengths. Their market leadership in that fast-growing e-infrastructure space. A proven track record executing big, complex projects. That diversified model across 3 segments. Strong and improving profitability and margins. Robust free cash flow. The solid balance sheet with net cash. Experienced management, and that strategic geographic focus in growing U.S. regions.
Seems like a solid list. What about weaknesses? Where are they potentially vulnerable?
Weaknesses identified include that recent stock price volatility we discussed, a growing reliance on e-infrastructure, which brings concentration risk if that market slows, the inherent lumpiness of project-based revenue and earnings, that recent CFO transition introduced some management uncertainty, and potential challenges integrating all those acquisitions smoothly.
Okay, now for the external factors. Opportunities, what could really benefit Sterling going forward?
Several big opportunities. Those strong secular growth drivers, data centers, advanced manufacturing, AI, cloud, onshoring, all fueling demand.
Right, feeding that e-infrastructure engine.
Right, feeding that e-infrastructure engine. Exactly. Then there's the Infrastructure Investment and Jobs Act, huge potential funding for their transportation segment. Opportunities also exist to expand geographically or into adjacent services, use technology to boost efficiency, capitalize on the growing focus on sustainability in construction.
And maybe improve margins further.
Yeah, potentially further margin expansion by being selective about higher margin projects. Lots of potential upsides.
Conversely, threats. What external factors pose the biggest risks?
Key threats include a potential broad economic downturn hitting private construction demand, the impact of interest rates on project financing, just intense competition in the construction world, volatility in material costs, ongoing skilled labor shortages, changes in regulations or permitting, risks in just executing these massive projects successfully, potential impacts from U.S. tariffs, which we should discuss, and longer-term climate-related risks.
Okay, yeah, the research specifically mentioned the 2025 U.S. tariffs. What's the thinking there for Sterling?
It's complicated, frankly. Both potential downsides and maybe some indirect benefits.
Downside first.
Increased costs for materials, equipment. Even if they don't import much directly from China, global supply chains get disrupted, domestic alternatives might get pricier. That could squeeze margins if they can't pass costs on.
Okay, and the potential upside,
Well, tariffs could further encourage onshoring of manufacturing back to the U.S.
which directly benefits their e-infrastructure segment.
Exactly. More demand for new factories. There are also indirect effects. Client financial health, competitive shifts. But since Sterling is mainly domestic, their direct exposure might be less than some others.
And can they manage the cost side?
Their project management expertise might help mitigate some risks around material costs. But ultimately, the net impact depends on which materials are hit, how negotiations go, and the wider macroeconomic fallout. It's definitely something to watch.
Okay, that gives a really thorough view of the risks and opportunities. Let's wrap up with our final chapter, Chapter 7. Brief conclusion and the end hook reveal. So, boiling it all down, what's the main takeaway on Sterling?
Well, in conclusion, Sterling Infrastructure has clearly pulled off a major strategic transformation. They've positioned themselves really well in high-growth infrastructure markets. Their recent financial performance has been strong, management seems capable, and that balance sheet is robust. Net cash is a big plus.
But the market's been shaky recently.
Right. That recent sell-off creates uncertainty, maybe some valid investor concerns, but it could also represent a value opportunity if that underlying business momentum keeps going. Investors really need to weigh the strengths and opportunities against industry cyclicality and those external risks like tariffs and the economy.
So execution and navigating those risks are key.
Absolutely critical for their future success and creating long-term shareholder value.
It sounds like maybe from a value investing lens, it ticks some boxes. Understandable business, maybe a narrow moat in e-infrastructure, able and trustworthy management based on the track record, financial strength, and maybe an attractive price now.
That's a fair summary, yeah. It seems to align with several of those principles. But as always, you have to really consider why the market is concerned right now. Do your own homework.
Absolutely. Which brings us perfectly to our end hook, a final thought for everyone listening to consider independently.
Okay.
Given that strong analyst consensus with those high price targets, but also the recent significant drop in Sterling's stock price, what specific metrics in their upcoming earnings or maybe other news events you think would be the most crucial signals? Signals about whether the market's worries are justified or if this really is a significant long-term opportunity.
That's a really good question for listeners to mull over as they do their own research. A critical one, actually.
Well, that wraps up our deep dive into Sterling Infrastructure. We really hope this detailed analysis, pulling from the sources you sent over, has helped everyone get a much clearer, more informed picture of the company.
Absolutely. Understanding all these different pieces, the business, management, financials, risks, it's all essential for making good decisions.
And if you found this level of detail valuable and you want to explore other companies like this, definitely subscribe to the Stock Analytics AI YouTube channel. We put out deep dives like this regularly.
Yeah, lots of great analysis there to help with your investment journey.
And finally, just the usual reminder. This deep dive is purely for informational purposes. It's not personalized investment advice.
Right.
It's really crucial to do your own thorough, independent research and due diligence before making any investment decisions. The information we talked about is based on sources from April 10th, 2025. Things can change.
Market conditions, company performance.
Yeah.
Always evolving.
And this analysis did incorporate insights generated with AI assistance. We aim for accuracy, but always best to verify info from multiple independent sources.
That's a very important disclaimer. Always do your own homework and maybe talk to a qualified financial advisor if you need to.
Thank you for joining us for this episode of The Deep Dive. We look forward to bringing you another insightful analysis next time.
Until then, keep exploring and keep learning.